In this video, I will show you what is a gold scalping strategy on a 1 minute time frame. It is very fast minute time frame, and it is possible to trade it on a gold which is highly volatile, and that means the price can jump very fast and very quickly on high levels, from the highest price to the lowest price on the chart. For scalping on a 1 minute strategy on the gold, you need to have a clean strategy. And in my case, I would like to show you what is the one that is currently used on the chart. And that is by using a support and resistance levels and the supply demand zones, which are around those support and resistance levels. And that is all what you need. It's nothing else needed for trading on the gold on the 1 minute scalping strategy. On the chart, you can see I have put trend lines here just to see what is the trend currently on the market, but they are not 100% needed if you do not want to have them. For some traders, it is not so easy to draw these trend lines correctly to get the channels and also to see the trend. But if you would like to have them, feel free to have, because they help you to define where is the confluence of, for example, a resistance, like in this case here, and also confluence of support, for example, right here. A confluence of support and resistance gives you more power to those places, which represents a higher strength of support and higher strength of resistance. Now, for the scalping strategy, there is only one rule to follow when you're trading, and that rule is to enter and to exit at a specific time. And to enter at a specific time is when the price goes above or below support or resistance line. Now, in this chart, I have drawn these horizontal support and resistance lines, and the brown area around them is the supply or demand zones. I will explain them during the explanation of the strategy, but just I want to give you a short overview. I have selected this part of this time frame here on the chart, and I will start from this vertical line. How to start trading? Well, first of all, you need to prepare yourself to be very fast by using your trading platform, because you will need to enter and exit very quickly on specific occasions. And that means when the price goes above or below, you will need to enter very fast with already defined lot size, and you will need to exit very quickly to close the order that is currently open. Now, if you are able to have open several orders at a time, it is up to you. But for start, you can also start using a demo account, try with only one order open at a time, and see from there, is it possible or not to move with a higher number of trades or not. Okay, the first rule, when you have prepared your charts, which are very clean, there are no indicators, it is only support and resistance and supply zones. If we go start from this vertical line, the rule is always enter into the trade when the price goes, in this case, below the support level when the candle closes. Remember that in this case, you can see that the price has gone down with a wick, but the candle did not close below, so you would not enter into the trade. In the next attempt, we can see the price goes down, the price comes to the support level and then bounces back up, go to the resistance and continues to bounce between the support and the resistance levels. Your goal is to wait when the price goes up above the resistance and closes the candle, and then enter, or the price goes down below the support and then enter. Now, in this case, we can see that the price has tried to move down several times, but it could not make a breakout to the downside, which means closing the candle below this support level and also below this currently ending of this demand zone. Demand zone is always around the support level. A supply zone is always around the resistance level. Now, in this case, we can see this candle has gone below, and it has reached with candle close price below this support level. This is the time when to enter. When do you enter? You wait until the price reaches the next support level, the start of this support level. Now, it is very important to remember that the supply and demand zone. So we can see in this case, it is the start of this demand zone, and this is horizontal support level. It is very important that you know that the start of this demand zone is the exit place for the trade that you have open in this case. When you open the trade here, you exit the trade at the start of this demand zone. Why is that? Because usually the demand zone in this case has been drawn on the chart where the price usually most of the time comes very close to the support level. In some occasions you will see that the price do not come to the horizontal line, but it bounces from this start of this demand zone and goes in the opposite direction. So your goal is to exit before that bounce happens. It is better to be on the safe side. Use a smaller profit than a way to be with a full profit, but instead of getting out with the trade with a profit, you get out and close the trade with a loss. So in this case, you would enter here when the candle has closed the price below the support level, and then exit at the start of this demand zone, very close to the support. Now when you have exited, the way when to exit from the trade if the price doesn't go in your favor. For example, if you have entered in the trade here and you have waited for the price to go down, but the next candle has immediately reversed and closed the candle above, currently this one here, the support level, if the price closes with the second candle above, you exit immediately. But have in mind that sometimes the price can go up and then return back down, closing the candle below with a higher wick. In this case, you do not exit the trade. The stop loss should be always placed above this one, which is the first resistance level. So it is very wide stop loss, but this is the scalping strategy. So you have almost the stop loss similar as a take profit, or a stop loss which is a little bit bigger than the take profit. But in the scalping, it is always the idea to have much more better trades than the losing one. And you will see in this example how this goes. So in this case, you would exit with a profit. Now the market moves down, and then you wait for another attempt. In this case, you are waiting for the price that has come very close to the support level. It is at the demand zone. You are waiting for the price to go down. Now the market did not go down. In 5 minutes, the price starts to move up. You come here, wait for the price to make a breakout with a candle close above. And in this case, we can see that the price has made a bullish breakout. You enter the trade here, where the candle has closed, and then wait for the price to reach the start of this supply zone, which is very close to the resistance level. Now, the rule I have said when to exit from the trade. Stop loss would be at the start of this support level, but you will manually exit the trade if the candle comes very close below this support level. We can see that the price has come to the support level, but it did not go down below this lower side of this demand zone. So you leave the trade open and wait for the price to go below this one or to go up. Now, after this one, we can see that the price has come very close to the support level, but the candle did not close below this one. So the price has gone up and you have exited the trade with profit here. Now in this case, you are currently waiting for the price makes a breakout to the upper side to move up. But we can see that the price is bouncing back down, reach it very close to the start of this demand zone, then return it back up and made a breakout here. So in this case, you would watch for the price to close the candle above this resistance level. But in this case, the price returned back down again, then bounced again and again, and here the price has made a breakout. So the candle has closed here. You enter the trade here and you wait for the price to reach the start of this supply zone. The automatic stop loss would be down here at the support level, but manually stop loss would be when the price comes below and closes below this demand zone. So in this case, you are waiting for the price to reach the start of this supply zone. In this case, the price did not reach, but it has reversed back down and closed below. In this case, you manually close this trade. You move forward and you wait for the price to come to the support level and to make a breakout. And the second candle, we can see the price has made a breakout. You enter the trade here, wait for the take profit here, and the stop loss would be right here. But manually stop loss would be with the next candle just above. In this case, the price has continued to fall down and it has reached the take profit. You exit the trade with a profit and then you wait for the price to make a breakout below this support level. And this is the candle that has been closed below this support level, below this demand zone. You enter the trade here and you wait for the price to reach this target, which is the start of this next support level. Now, we can see that the price has tried to move up, but you do not get out from the trade until the candle closes back above this support level. So in this case, the price has tried to reach, did not reach this resistance level, which is automatic stop loss, and the price has returned back down where the candle has closed with a candle open with the candle price close is below the support level and the price continued to fall down. You exit with a profit. Then you wait for the price to move below that. In this case, you also move with this price. You enter the trade right here. Just a minute. In this case, it is the open price for the trade. You wait for the price to reach this price level, but if the price goes up, it activates a stop loss, which is automatically set. Now, in this case, we can see this is the bad trade. You move forward. Then you wait for the price to make a breakout above this resistance level. And we can see this candle has closed above. You enter the trade waiting for the profit here, or the stop loss would be placed here. But manually stop loss would be activated when the price closes with the next candle just below this support level. And in this case, you would exit the trade here because the price has returned back down. Immediately as the price has made a breakout back down, you enter the trade with the next candle here because it has closed the candle just below the support level. You are expecting for the price to return back down. And in this case, the price has reached a take profit. You exit the trade. Then you wait for the next candle that moves down. In this case, you have exited the trade with a profit, so you wait for the next candle to move up or down. In this case, the price is doing back up, made a breakout here, but you do not enter in this one because the price is closed just at this resistance level. If the price closes very near to this resistance level, then you start the trade because there is no point that you enter the here and exit here on the small profit. Now you wait for the next opportunity. You can see every 4 to 5 minutes you get a new opportunity to trade. Now in this case we can see what happens. Then in this case the price has made a breakout to the downside and the close price is below the support level. You wait for the price to reach the next target, which is the start of this support level. But if the price goes against you, you get out. In this case the price has reached a take profit. Then you follow the next one. When the price reaches, you can skip this one, you wait for another opportunity. Now the price jumps between this resistance and the support level, and then you wait for the price to make a breakout. The price makes a breakout here, but the price did not close with a candle below. It is only the wick. And in this example, the same, you wait for the opportunity. Then here, the price makes a breakout. First one, second one. Only when the price closes the candle. Here, you start the trade. In this trade, you are expecting that the price will reach the start of this resistance level, and in this case, the price reaches this and the take profit has been activated in your case. Let's move forward. Then, in this case, you are waiting for the price to make a breakout to the upside, but the price is back down and closes the candle just below this support level. You enter the trade here. You wait for the price to reach the start of this support level and you exit with the trade. Now, next one, where the price moves, you wait for the price to make a breakout, but the price returns back up, and in this case, the candle closes below the support level, so you wait for the price to reach take profit. The price goes down, reach take profit, you exit with the trade with the profit. Then you wait for next move, where you wait for the price to make a breakout, and in this case, the price makes a breakout here. You wait for the take profit, the price did not reach take profit, return back down, and the price did not close with the candle body below, so you stay still active. Your trade is still active and you exit with a profit. So you move forward and you wait for the breakout. In this case, we can see that the price has made a breakout, a bullish one. Then you expect that the price will reach this one, but the next candle closes below. You exit from the trade with a loss. Then you wait for another opportunity. The next one, this is not good because it's very close to the resistance level. You wait for the price, and here the price makes a breakout to the downside. We can see the price reaches this one, close the candle, you start the trade, and the take profit activates here. You move for and you wait for the next move. The price goes here, comes very close to this resistance level, did not make a breakout with the candle closing above this area, which is currently a supply zone, a resistance. The price goes here. It is up to you, will you enter the trade here, but it is not very good because the small profit and very loss could be activated. Now in this case, the price had made a breakout, you enter the trade, you wait for the price to reach take profit, but the price goes down, close the candle, you exit the trade here with a loss. Then you wait for the next opportunity. This one is not very good because it's very close to the support level, you skip this one. The price returns, you skip this one also because it's very close to the resistance level, and you continue to doing the same scenario all the way up and see how to trade. You can see in the past, in the future, you can see how the price has behaved, but the scenario is the same. You wait for the price to make a breakout. At the end, you will see how much of the positive and negative trades you have seen. You have seen that in this trade, you had most of the time very good trades and activated with a profit, instead a stop loss. So it is up to you to test this one, but you can see the idea is to wait until the price makes a breakout above the resistance, which is a supply zone, or below a support level, and get out on the next start of this demand zone. So this is the idea, the only idea that you need to follow. There are no indicators, only a support and a resistance level that you need to follow. There are other things that you can also use, which is a price action signal. For example, if you have a pin bar located at the support level, on the gold is usually a signal that the price will go in the opposite direction. So this is all for scalping strategy for the gold. If you have any questions, feel free to leave it a comment. I will try to answer as soon as possible. But also I would like to thank you if you click the like button and subscribe so you get more information about the strategy I'm using on the gold. See you next time and happy trading.